Hi everyone, this is Cherry Chan from Real Estate Tax Tips. Welcome to my YouTube channel. Today, I'm going to talk to you about how to write off repairs and maintenance the right way with CRA. Have you ever replaced a roof and wondered if you would be able to write it off against your rental income? Have you bought a set of new appliances for your rental properties and wondering if you would be able to get some money back from CRA? Or did you just incur a bunch of money renovating your basement unit for rental purpose and converting it to legal secondary suite and wonder if you would be able to write off the expense and get some CRA refund back? If you have one of those questions, you are in the right place. Today, I'm going to show you how to write off repairs and maintenance the right way. Before I move on to the detailed analysis, make sure you give us a thumbs up if you like the video, comment if you have any questions, and subscribe to our YouTube channel so you can stay on top of all the latest tax tips for real estate investors. If you're a real estate investor, all of us would know that spending money on improving our properties and also our money generating asset is inevitable. And CRA has set out specific criteria to help taxpayers to guide us on how to expense these items. This includes the criteria to determine whether an expense is considered capitalized expense or current expense. Now, what is current expense? If a roof replacement is classified as a current expense, what does that really mean to all of us? Now, if a roof replacement, a brand new roof, is classified as a current expense, it could be directly deducted against your rental income received, and you immediately in the same year that you incur. So that's very important because you get immediate tax benefit, and it is 100% against your income. So it could be 100% that's being used to offset against your rental income. It is written off similar to all the other current expense such as mortgage interest, property tax, and insurance against your rental income. If you incur a loss as a result, rental loss as a result, you can even use it to offset against your employment income. Potentially, you would be able to get a tax refund as a result. So this current expense, so-called current expense, allows you to deduct and offset against the income that you earned, so you get immediate tax write-off. And if you report that in your rental property, if your rental property is reported in your personal name, this $10,000 roof that you just incur would allow you to save as much as $5,000 income tax. So huge bias for a taxpayer to classify an expense as repair and current expense. So what is capitalized expense? Capitalized, when an expense is being classified as capitalized expense, then the capitalized expense is being added to the cost of the building. You do not get immediate write-off. Now let me use an example to explain to you how this works. Now, let's say you purchase a rental property for $500,000. The property you purchase it for $500,000, okay? And then you spend $10,000 on a brand new roof. Can you write it off? If you cannot write it off, you can still claim it. You have to add that $10,000 to the property purchase price plus the $10,000. Now your revised property purchase price, or what we call in tax term is called adjusted cost base, is now $510,000. When would you be able to claim that $510,000 as a deduction? It is when you eventually sell the property. Assuming in a few years you decide to sell the property for $600,000 and you sold it for $600,000. Now you can claim the entire $510,000 against your $600,000. The net capital gain is now $90,000. So you would only get the tax deduction when you eventually sell the property. Now, because later on, because it is capital gain, and one of the benefit of earning capital gain as your income is that it is only 50% taxable. So out of the $90,000 profit that you made from selling your rental property, only 50% would be taxable. So only $45,000 is taxable. In other words, any capitalized expense that's being added to the cost of the building would be only 50% taxable. So now let's get back at answering your questions. Can you write off the $10,000 new roof that you just put on your rental property? Now here are some of the criteria that CRA looks at. Are you improving the roof or are you just restoring it to the original condition? replacing basic roof with basic roof shingles is considered a current expense. So there is no improvement. You're restoring the shingle to its original condition. There is no significant improvement to the value of your house, and that's considered one-time write-off. Now, if you, on the other hand, like my neighbor, they have a really nice roof. It's a metal roof. If you're replacing a shingle roof with a metal roof, that's called improvement, because now you are improving the property. And presumably, and the reality is that the marketplace perceives that metal roof, because it lasts forever, as an improvement. And therefore, if you replace your shingle roof with metal roof, it will be considered a capitalized expense, and it's being added to the cost of the building, and you would not get the tax write-off immediately. Okay, your second question, when you purchase a new set of appliances, are they considered current expense or capitalized expense? Now, again, similarly to the roof, shingle roof example that I gave you, if you are replacing the current set of appliances just so that you're restoring them to the original condition, which typically all landlords do tend to buy the least expensive type of appliances to replace at a rental property, and so you're buying basic and replacing the basic old one, then that would be considered again current expense. But on the other hand, if you are taking the old appliances, basic white ugly version of appliances, and improving it and get the black stainless steel, the latest model, then that would be considered capitalized expense, and you would then have to add it to the cost of the building or set it up as a separate class of assets on your rental income reporting schedule. And you would be able to deduct it using a different method, but no immediate write-off. Okay, the last question that you guys have is the legal duplex conversion. I know a lot of us, including myself, I'm a legal duplex or legal secondary suite investor. We spend tons of money converting the basement into a legal secondary suite, trying to maximize the amount of revenue, the rental income that would come in from the property. And that $100,000 or sometimes even $150,000 that you spend on the conversion, is it a tax deductible expense, a current expense, or is it a capitalized expense? Now that really depends. The reason why it really depends is because the pure magnitude of that $100,000, $150,000 is substantial. And it also goes back to the amount of work that's being done and the condition of the property and the timing of the renovation. So let's just use an example. If I just go into Hamilton today, buy a single family home, post-war bungalow, raised bungalow, okay? The basement is completely gutted. There is nothing there. And I'm putting the legal 2-unit in there. That $150,000 is totally considered capitalized expense because you're improving the property. You are increasing the value of the property. It is considered capitalized expense, and the $100,000 or $150,000 has to be added to the cost of the building. You don't get your immediate tax write-off. On the other hand, let's say I own this property for a long time and it has always been illegal basement rental unit, or that could be what some people have been doing. They have an existing secondary suite in the basement, but they are only doing a minimum amount of conversion work, including just installing a new window. You may be able to argue that you're not improving the value of the property significantly, and there is no extra benefit to the property value, and you would be able to write off some of these expenses as current expense. So now that we go through all your questions, the last thing that I want to talk about is the exceptions in these rules. We've gone through the roof example, we've gone through the appliance example, we have also gone through the legal duplex conversion example. Now the last thing that I want to mention is that there are exceptions to the rules described above. I'm just the messenger, don't kill me, because I'm not the one who created the Income Tax Act. It's inherently extremely confusing. So I wanted to bring up these two exceptions. If you incur the expenses immediately after you purchase an old house to get the house ready for rent, So whether or not you're buying, like you're doing the roof repairs, whether replacing the roof, whether or not you are replacing the appliances and doing the legal secondary suite conversion, immediately after you purchase the property, that expense is considered capitalized item. It is not considered current expense. So timing really matters, okay? Same thing goes to when you do all these work immediately before the sale of the property, just so that you are getting the house ready for sale. All these expenses that you incur for the purpose of getting the house ready for sale are considered capitalized expense, and that would have to be added to the cost of the building and deducted accordingly as capitalized expense. Thank you so much for watching my video on how to write off your repairs and maintenance on your rental property the right way. If you like our video, please make sure you subscribe to our channel so you can stay on top of all the latest tax tips. If you have a question, make sure that you comment below and I will get back to you personally. And if you like this video, make sure you give us a thumbs up. And if you see any value in the video or anyone that would be able to use this video to help them with their tax deduction, make sure that you share that with them. Until next time, thank you.